Please stay tuned for important disclosure information at the conclusion of this episode.
This is Destination Retirement with Robert Kuhn from Kuhn Capital Partners. When a part of your financial strategy is out of tune, your long-term goals, your retirement savings, and your legacy can all suffer. With many years of experience in the financial industry, Robert provides his clients and prospects the information they need regarding Social Security, retirement income planning, wealth management, and much more. Listen in as we address your financial concerns and provide helpful strategies to put you on the path to achieving your retirement goals. And now here is Destination Retirement with Robert Kuhn.
Welcome. I'm Robert Kuhn. This is Destination Retirement. Thank you for joining us this weekend. Wow, a lot can happen and a lot can happen quickly. So we have a lot to get to this week, and I want to make sure that we are going over many topics. It's amazing to me how fast risk can happen. And I want to go over that. I want to go over inflation. I want to go over the Social Security increase and how that's simply not enough and not keeping up with inflation, and why some people are going to have a very challenging time with that. But I think, when we look at our job as advisors, our job as fiduciaries, our job as really being consultants to you is to do a couple things. First and foremost, I hear over and over again that one of our greatest attributes is the ability to take complex topics and break them down. So someone who's not in this industry, who doesn't deal with this information 24/7, 365 for 25 plus years, can make good educated decisions. And hopefully, if you listen to the radio show, you know that is our first goal. It's our last goal, is to really just let you know that there are strategies that can do well when the markets are not doing well. There are ways that we can minimize risk. There are ways that we can make money when the markets are negative. And those are the things that we want to make sure that you are incorporating into your portfolio, especially in a day and age like we are currently facing. So with that being said, I guess our 30-second elevator speech or pitch is really simple. We're fiduciaries. Everything we do is built around that. Everything we do is built around financial planning. Everything that we do is around future income planning. And our job is to look at asset allocation in a unique and distinctly different way than our competitors, and we do. And our job is to have protection. Our job is to have growth. Our job is to have opportunistic growth. The markets can go three ways: up, down, and sideways. And our job as advisors is to craft a portfolio that can do well, or have attributes that can do well in all markets. And it's unique and it's different, and it just is what it is. So if you want to have a conversation with myself this week, you can call Paige. Paige will schedule that time that works for you and I. You can reach her at 630-492-1912, 630-492-1912, or you can go on the website to kuhncp.com and schedule that yourself if that's easier for you. First thing I want to really go over is we've always had a good response to the radio show. We've always had, people reach out, and I really commend you for, going out on the ledge just a bit and reach out to somebody that you don't know, someone that you hear on the radio. We're certainly not the only radio show, but I think what differentiates us is our ability to educate, our ability to break down complex topics into bite-sized pieces so you can understand what makes an advisor, at least our advisory firm, different, because we're not all created equally. And we're going to go over today just how a few percentage points a year over time can create just a significant difference in your outcome. But so I want to thank you first and foremost for reaching out. That's obviously very important to us. And I think I look at the podcast numbers and it shows that, accomplishing what I set out to accomplish, which is to educate, which is to give you the ammunition to make sure you have a portfolio that can do well in all three markets, whether it's up, whether it's down, whether it's sideways. And if you end up working with us, fantastic. If you end up doing it on your own and you take nuggets from the radio show, then I did my job. So, when we started talking about the dual directional banknotes that we do, we saw a significant increase in people reaching out. And I think it's new to people to first off, to realize that they're investments that can do well and make money when the markets are negative. And I don't think many individual investors understand that. And you have a lot of, well, how is that possible? Well, that can't be. Well, it is. And if you look at what institutions do with their own money, and you look at what advisors do, and you look at pension funds and what they do, they generally speaking are always hedged. And this is probably a good week to talk about hedging because of what happened in Israel and what is going on overseas, and what that did to the market, at least headlines. And it seems like that conflict is currently contained, but it can spiral out of control very, very fast. And so I think one of the messages that I want to get across this week is you have to have a portfolio that can handle geopolitical, market, interest rate, etc. shocks. And if you don't, you are doing yourself a significant disservice. So I had lunch this week with a client in our Dallas office, and for those of you that don't know, we have multiple offices, and we do have somewhat of a national client base. So if you're listening to the show, we can work with you. That's always the first question that we get. We have representation. We have a location in your area. We are based out of Chicago, but we get to Dallas, we get to Northern Florida, we get to other areas throughout the country often. So if you're hearing the show, don't let the advice that you're being given financially be defined by geography. With Zoom, with our locations, with guess what? Airplanes. We go out and we meet clients all the time. So I had a lunch this week with a client, and, he said something that really resonated with me. He's a commercial airline pilot. And for those of you that don't know, we do work a lot, maybe extensively, with commercial airline pilots from most of the major carriers. And he said, I don't really look at my investments all that much because I'm a dollar cost averaging type of a guy. And I thought, well, you know what? That's fantastic. And I want to break that down in what that truly means. When you're still working, dollar cost averaging is simply, putting money in at a systematic time, whether it's weekly, monthly, whatever. And then you're buying the investments, throughout the year. And so in theory, you're buying them when they're down and when they're up and when they're down and when they're up. And over time, ultimately, you hope that the market is going to go up when you need it. We certainly don't believe that that's the best way to acquire wealth. That doesn't mean that we're trying to predict the market in any way, but I think our job is to miss the big dips. And if we can miss the big dips, well, then, we are ultimately going to, produce more future cash flow or more growth for you. But dollar cost averaging, when you're still working and when you have 20 plus years left to retirement, it's really not the worst thing in the world. Okay. But as you get closer to retirement, dollar cost averaging is not going to play or provide you the defense that you think that it may. And that is a concern of mine because there are periods of time that the markets are weak. They're weak for extended periods. And if you've listened to the show, you know what my next statistic is going to be. It's going to be if you bought Microsoft in 2000, took you 14 years to get back to even. So we have to make sure that if you're 5, 10, 15 years from retirement, that your defense mechanism inside of your portfolio isn't only dollar cost averaging. And so that is something that we want to make sure, because like I explained to him, now he you had a rather large IRA, and that's the challenge here. For new money, dollar cost averaging is okay because you're putting it in and hopefully buying it, whether it's up or whether it's down. But what does that do to the principle of your current investment? And that's what I want people to start to think about. So we have to look at other strategies that can protect risk, and we'll get into many reasons why today on the show. But obviously, just look at how quick risk can happen and how the outliers can happen. And that's one of the reasons that if you're working with an advisor that is still using probability analysis as the only income predictor as far as whether you're going to have enough income in retirement, that's just not good enough, because income isn't pass or fail. And if for those that have talked with us, our Income Labs software has just been phenomenal. It's been very, very enlightening to people to see, when they can get raises, when they have to, potentially cut back. So again, when we started to see the dual directional banknotes and we started to talk about them on the radio, a lot of people told me not to do that because it was confusing and it was, hard to articulate, without sitting down with somebody, but it's not. It's very simple. I mean, it truly is. You have a cap on the upside, you make money on the downside to a certain point, and then you have a buffer if the markets ultimately go down. So 630-492-1912, 630-492-1912. If you'd like to talk with Paige, set some time up for us to have a conversation. The last one we did was a Morgan Stanley dual directional banknote. So you're buying the credit of the bank. So we're only going to use tier 1 banks clearly, but the cap on the upside, it was 15 months, was 22%. So, over the next 15 months, you're going to participate in the gains of the S&P 500 or the Russell 2000, whichever of the performance is actually worse. That's how they capture it. But you're going to get 0 to 22%. So you get 100% of the returns as long as those returns fall between 0 and 22%. So if they're up 7, you're up 7, 10, 10. If they're up 25, well, you're only up 22. So again, we have to look at where we're positioning this money. And this is kind of in our protection bucket. So you have to be content with 22% of the upside over the next 15 months. But here's where it gets really interesting. This had what was called a 15% absolute return buffer, meaning the least performing of the indexes, if they were down 0 to negative 15, you actually received the inverse return. So you heard that correct. You made money if the markets were down. So if the S&P, let's say, was down 15, well, you were positive 15. 7, you were positive 7. So anything from 0 to negative 15, you actually made money. And then negative 15 or more, you started to lose money and incur losses. And so look at negative 15 as your 0. So if it's down 16, you're down 1, 17, you're down 2, etc. So when we look at crafting a portfolio, so many people are still using fixed income as the only portfolio diversifier, portfolio stabilizer. And my simple question to you is, how has that done for you? We're in the worst 3-year period in the fixed income market. You can be down 15%. You can be down 45%. It just depends what you own in the fixed income space. So we have to look at things differently. And if you're content with, 22% on the upside over 15 months, and you want to make money as long as the indices are not down more than 15, and then you have a buffer on the downside, well, guess what? That could have been a very good investment for you. So, we do these probably 3 or 4 times a month. And part of the reason that we do it 3 or 4 times a month is very simple. The more that we can aggregate from investors and give to the banks, the greater the yield is, or the return, or the caps that we're going to get. So that's, what we do. So if you have an interest, let's talk about when the next one is coming up. It could be a JP Morgan one. It could be a Bank of America. It could be a Morgan Stanley, a UBS. I mean, the price pricing or the bank is really whoever bids the best. And as long as their credit rating is strong, then we're certainly comfortable with them. So with that being said, give Paige a call and let's see when our next one is. It'll probably be in 10 days. So we want to make sure that we have several million that we can ultimately give them so we get the best rate for everybody. So give Paige a call, 630-492-1912, 630-492-1912. We're going to talk about inflation. We're going to talk about Social Security cost of living, and we're going to talk about the difference that a few percentage points a year can make. And I think people will be shocked. So hang with us. We'll be back after the break.
Are you considering buying an annuity? Or did you buy an annuity because you were promised stock market-like returns with no downside? If you own the wrong annuity, there is a great chance you've experienced little to no growth over the past few years. In many instances, the insurance agent received more in commission than many have in actual investment growth. If you'd like to learn more about our annuity repair strategy, please call Robert, 800-674-3217. Again, that's 800-674-3217. With Kuhn Capital Partners, partnership isn't just a promise, it's in our name.
Welcome back. You're listening to Destination Retirement. My name is Robert Kuhn. I'm the president, founder of Kuhn Capital Partners. We're independent. We're a registered investment advisory firm. We are a fiduciary. If you're listening to this show, yes, our headquarters is in the Chicago market, but if you can hear the show and if it's playing in your market, then guess what? We can work together. So don't let that hold you back by a 630 area code. And I know I have to say that, but I get a lot of questions from people in other markets that we run the show is, can we work together? So the answer is yes. So our job is, as you know, if you've listened to the show, is crafting a portfolio that can not only do well in an up market, but can, in theory and in practice, deliver returns, whether the market's up, whether the market's down, or whether the market is sideways. So that's our job. Most clients, most advisors, most portfolios, you're going to do very well. Are going to do well when the markets are up. Again, most advisors can easily craft portfolios to do well when the markets are up. However, most, if not all, but certainly most, their clients are going to lose money when the markets go down, and then they're going to explain away why it's okay to lose money. So our job is to craft portfolios that have strategies that can do well, whether the market's up, whether the market's down, or whether the market's sideways. So with that being said, if you have any questions investment related, you want to reduce your taxable income. I know this is something we talk an awful lot about. Two things that we need to talk more about. 401k management. If you have a 401k and it's at Charles Schwab, if it's at Fidelity, if it's at Empower, if it's at Vanguard, if it's at a big provider, there's a good chance that you can have professional money management inside of your 401k, meaning it can still stay in your 401k, but you can have somebody that can manage that portfolio for you. So that's something I want you to think about. It's generally, 401ks are great, but it's very challenging to manage risk inside of 401ks. There's generally not cutting edge strategies that can do well when the markets don't do well in 401ks. So if that's you, let's have a conversation. And number two, taxes. Tax planning is a year-round thing. It's not, we don't start planning for reducing taxes in April. Okay, we've got the rest of October, we have November, we have December, and we have some tax strategies. Again, if you've listened to the show, you know that one of the most overlooked areas of financial planning for those that are $5 million, $10 million and under is tax planning. So if you have $100,000 or if you have $10 million, we don't want to pay any more taxes than we have to. And we have some strategies that you need to hear about for this year because we can get the tax benefits for this year. So come April, you're going to be really happy if you sold a business, if you sold a building, if you're a high wage earner. There are strategies that can pay very strong distributions, generally speaking, double-digit distributions, and you can reduce your taxable income by 80 to 85% of your investment. Meaning, if you invest $100,000, you can have a depreciation, a loss for accounting purposes to reduce your taxable income by $80,000 to $85,000. So think about that. that is something that we have to talk about. There's pros, there's cons, there's risks, there's rewards. We have to talk about it. But if you sold a business, if you make a bunch of money, if you sold a building, or if you just don't want to pay more taxes than you have to, you want to do a Roth conversion, you want to mitigate that additional tax due, let's have a conversation. So give Paige a call, 630-492-1912, 630-492-1912, or you can go on the website, KUHNCP.com. As you know, we podcast every episode, so you can listen to all of our past episodes. I think, well, not all, actually, only half, but there's still multiple. I think there's 100 and something on there now. But when we changed, well, I don't want to get into the nuts and bolts, but we have a few years that didn't come along with us from the radio. So let's talk about inflation. And for many people, we have clients, and I get asked often, do you have to have an account minimum to work with us? And there are a lot of advisors that you have to have 500,000, you have to have $1 million, you have to have 5 million, you have to have 10 million. And we've always taken the approach that to work with us is not based upon how much money you have. Now, I think there's certainly a amount that you need for us to do what we want to do, but we'll certainly give you advice no matter what. So, generally speaking, we like to have investors that have a minimum of $250,000 of investable assets or 401k assets that we can actually manage. And, our job is to make sure that we're providing you a institutional level diversified strategy. And diversification isn't the amount of investments that you own. Unfortunately, I've seen people who have owned hundreds of different equities and ETFs and mutual funds, and they weren't diversified in any way, shape, or form. And they simply track the market up and track the market down. And if you need the money and we're in a down period, then guess what? That's just not going to be good for you. So our criteria to work with us is really twofold. Number one, do you need help? I mean, do you need the help? So, in our conversations, we're going to really determine if you need the help. And if you do need the help, are you receptive to that help? That is a big deal for us because we want investors that want to look at the world like an institution, like a pension fund, like a corporation, in that we want to, craft a portfolio that can do well, whether the markets are up, whether they're down, or whether they're sideways. If you just want to ride the market up, ride the market down, and then hope ultimately that we're in an up market when you need those assets, whether it's today, next year, 5 years, 10 years, 15 years down the road, we're probably not going to be a good partner. So we partner best with those investors that realize that you beat the market, you make the most amount of money, you generate significant wealth. Whatever wealth is to you, it's individualized. I have clients that have $500,000 and they're wealthy. I have clients that have $50 million net worth and they're wealthy. But you beat the market by losing less when the markets are going down. So don't buy into the old adage that it's okay to lose money, because guess what? Your advisor gets paid no matter what, whether they make money or whether they lose money. And when we as an industry went to a fee, unfortunately, I think in a lot of instances, risk management was thrown out the window, and it became more about convincing people that you're not smart enough to play defense. You're not smart enough to incorporate strategies that can do well when the markets go down. Why is that? Because I want my fee. I want my fee no matter what, whether the markets are up or whether the markets are down. Well, we don't buy into that. And so those are the clients that we're going to work best with. So 630-492-1912. Give us a call. If you're working with an advisor that is still utilizing that as their only source of, future income prediction or generating an income plan for you, it's not good enough. And that's one of the reasons that we use our income labs, which is a very dynamic approach of creating income and knowing when you can get a raise. Because if an advisor is still using Monte Carlo analysis as their only form of income prediction success, you don't know when you can take more money. You don't know when you have to take less money. I mean, you sit down with an advisor, you have $1 million or $5 million or 100,000, whatever it is. And then They, you look at what your expenses are going to be, and then they allocate with historical norms of asset classes and returns, and then they give you a probability of success. It may make you feel good. You may have a 75% probability or a 90% probability. I mean, what does that even mean? Because you have to realize that there are outliers. Outliers happen. Outliers happen quickly. Outliers, when they do happen, can throw the best income plan into disarray. And just look back, 23 years. So would you consider 2000, 2001, and 2002 to be an outlier? Absolutely. Would you consider 2008 to be an outlier? Absolutely. 2018 with COVID, and then certainly what's going on last year, and then what, we're starting to see this year. So here's the deal. Outliers happen more than you would think. And so our job is to craft an income plan that is predictable, that is in a lot of instances has some sort of a guaranteed component. If you do 100% guaranteed, you're probably not getting the distribution rate that you should be getting, but has some level of a guaranteed component or near guaranteed. I mean, so there are some really good strategies out there, and that have the ability to keep up with inflation. And we talked about inflation earlier in the segment, and anybody who believes that inflation is only 3.7, well, I just don't think that that's the case. So with that being said, our Income Labs, in addition to Monte Carlo analysis, is going to provide a much more comprehensive view of your income distribution plan. Again, whether you have $100,000 or $10 million of investable assets, it really doesn't matter. So with that being said, we're going to talk about performance. What does a couple percentage points of performance actually equate to a year over the long term? So give Paige a call, 630-492-1912, 630-492-1912, and let's have a conversation this week. More after the break.
Would you like your portfolio to be more certain in uncertain times? These days, there are more questions than ever. Before we can get to the answers, we have a question for you. What do you want to accomplish? Understanding the bigger picture is the first step to helping you pursue your goals today, tomorrow, and for generations to come. To schedule a complimentary call with Robert, please call 800-674-3217. Again, that's 800-674-3217. With Kuhn Capital Partners, partnership isn't just a promise, it's in our name.
Okay, welcome back. You're listening to Destination Retirement. My name is Robert Kuhn, president, founder of Kuhn Capital Partners, independent fiduciary, registered investment advisory firm, and the host of this radio show that hopefully you find some value from. We, as fiduciaries, our job is always to be financial planning based, but you can't only depend on a financial plan. I see that far too often, and financial plans, like I say, aren't worth the paper they're written on. If an outlier happens, if you lose money, financial plans are dynamic, especially when it comes to income planning. So if you're not 100% certain that your portfolio has strategies that can do well when the markets are up, make money when the markets are down, and still have trading strategies and investment strategies that can take advantage of a sideways market, given where we're at today, it's probably worth a phone call to have a conversation. So markets are just what the markets are. There's a lot of risk. I don't need to get into that because most people recognize that, but I don't think people fully understand what losses can do to a portfolio and candidly how fast risk happens. So with that being said, we love the market if your portfolio is constructed that in such a way that can do well in an up, down, and sideways market. So give Paige a call, 630-492-1912, 630-492-1912, and we can have a conversation. And go to the website. Many people may know we did update the website. We wanted to make it simpler. We wanted to make it just easier. There's some great blogs on the website. We do podcast every show, so you can listen to all of our past shows as well. And you can also request a consultation from the website, kuhncp.com, kuhncp.com. Again, a couple things. We don't have an investment minimum. Our criteria to working together is, first off, you need help. Second off, that you want help and you want to craft a portfolio that is not cookie cutter, that is not basic, that will not simply follow the market up and then follow the market down. So, whether you have 100,000 or whether you have 10 million, I don't want to say it's irrelevant to us, but it really, we don't care how much investable assets that you have. If you want help, need help, and are willing to learn about how to craft a portfolio that can do well regardless of what's going on in the market. So, and then lastly, if you can hear the show, we can work with you. So we are headquartered out of Chicago, but we have offices in multiple spots throughout the country. So with that being said, give Paige a call, 630-492-1912, and we'll certainly set some time up to have our initial consult and learn about what you're doing and see if we can help you in any way. So no question is too small, especially if you want to reduce taxes and you have or want some help inside of your 401k as well. Those are two underutilized services that we offer, and I want to make sure I start talking a lot more about that. You sold a building, sold a business, make your high wage earner, or you just want to reduce your taxable income. Let's have that conversation. We've got 2.5 months to invest in strategies that can greatly reduce your taxable income this year when you have to file taxes in April. So, okay, let's talk about investing. Portfolio construction. We haven't talked a whole lot about it on this show. I think, when we look at portfolio construction and investing and how do you construct a portfolio, we really look at 5 different areas, 5 different unique strategies, and each strategy is different. And when you look at protection, again, Wall Street has failed most investors. Advisors have failed most clients. I want you to look at your fixed income holdings. I want you to look at how much money you've lost over the last handful of years in your fixed income bucket. In generally speaking, that has been your portfolio stabilizer. That has been the only true risk management that many advisors are bringing to the table, and that simply is not good enough. We're in a 3-year bear market in fixed income, worst in history. You may be down 15%, you may be down 50%, depending upon where you were and how you invested in the fixed income space. And so when we craft a portfolio, we want to start with protection. First and foremost, we have bond alternatives. We have strategies that don't have interest rate sensitivity. We have strategies that are much shorter in duration than 5 years, 7 years, 10 years, 20 years in the bond space. And in many ways, they actually give more protection than what just a run-of-the-mill bond is going to do. And so when we look at a portfolio and we look at constructing a portfolio, we start with protection. We then go to growth. And when we go to growth, what encompasses growth is many things: our traditional equities and our traditional, investment portfolio, and then our dual directional or our risk managed growth strategies that can actually do well when the markets go down, strategies that can actually make money when the markets are negative. So hear me when I say that. Strategies that have 15% absolute return buffer, meaning if the indices that we're following are down from 0 to 15, that bucket of money is going to have a positive return. So if it's down 15, you have a positive return of 15. Down 7, you have a positive return of 7. So inside of growth, we have our protection strategies, which we don't really need to get into on the radio, but they're fantastic. We have our growth strategies. We have our traditional equity strategies, which we'll talk about here in a minute. And then we have inside of our growth strategy, we have our dual directional strategies that can do well when the markets are negative. When we look at our traditional growth strategy, it's very different than just what your traditional advisors are going to do. If you have over $100,000 and you own ETFs, or if you own mutual funds, I guess the question I have for you is why? Lack of transparency, lack of customization, lack of tax efficiency. I see far too many people that have, 7-figure portfolios that own index funds, that own mutual funds. And I just sit to myself and I think, why? I mean, really, it's anything over 100,000. You qualify for what I consider as individual equities. And when we look at our we have three strategies when it comes to the individual equity strategy. We want, first off, it's to provide strong risk adjusted returns. And we believe that when you can bring to the table a strategy that has ranked consistently in the top 5% of all money managers reporting into Morningstar for, they have to show periods of time, but generally these strategies are not falling out of the top 5%. But we have to look at just several, characteristics. We want blended, we want all cap, we want fundamental, we want tactical, and we want disciplined. Too many people are still using style box investing. What I mean by that is strategies that, that are going to, you have to have all cap, you have to have growth, you have to have value, small, mid, etc. That's just not good enough in today's market, in our opinion. We have strategies that are not constrained by having to invest in a style box. I mean, it to me, again, we want maximum flexibility. So we believe in quantitative analysis. We believe in a quantitative stock selection model. We believe in daily portfolio review. And when we look at growth, again, so we got protection, we got growth, and we look at, generally speaking, when you look at growth, many people don't think or may not fully grasp what a difference of 1% to 2% a year can make over time. So one of the strategies that we use has going from February 1995 to June of this year has an annualized return of 11.26%. And when you look at that, and you look at what the S&P has done during that time period, the S&P has done 10.29%. So we're not even talking about a percent difference. Okay. So think about that. We're not even talking about more than a percent. But when you look at what that has done over time, if you look at let's just assume we put in $1 million. You can use 100,000, but whatever, $1 million. Well, by getting less than a percent, but almost a percent more a year since that 95 to 2023, the S&P is slightly over 16 million, and this model is slightly over $20 million. So think about that. I hear people think and just kind of look at, well, it's only 0.5% more a year. It's only 1% more a year. Well, that's it. So we're talking about what, 0.97% ish of outperformance a year versus the S&P. Well, a cumulative return, that's 1975, so 1,975% versus the S&P at 1,518%. I mean, and that's barely 1% outperformance. So what value is that? Well, had you invested $1 million on February 1st, 1995 in that model versus $1 million in the S&P 500, the S&P ended up at 16.185, and this model ended up at 20,756,000. That's a little bit more than 1% cumulative return on average of outperformance. So fractions of a percent matter. We can reduce fees a bit. What if we can give you a little bit more performance for the growth? So again, I want to tell you, I have to give you all of the disclaimers. Past performance is not indicative of future results. We don't invest based upon what I just shared with you on performance. There's pros, there's cons, et cetera, et cetera. But I just want to make the point that you can, fractions of a percent matter in this game. So we got protection, we got growth, we've got opportunistic growth. Our opportunistic growth is something that most advisors don't have. They just simply don't. They're simply buy and hold, long only. They lay down a chart of 30, 40, 50 years. They rely upon average returns. And I guess the question that I have for you is, what does that mean for you when you may have 5 years, 10 years, 15 years left to retirement? Again, go back to the Microsoft statistic. You bought Microsoft in 2000. Took you 14 years to get back to even. Remember the lost decade in the early 2000s? 10 years of no growth in the S&P 500. So the question that I have is is it really relevant to your situation to have an advisor that simply relies upon historical market averages over 50, 60, 70, 80 years? And the answer to that is certainly I don't think so. So, we want to make sure that when you look at opportunistic growth, again, that's our money that we trade with. That's our money that we try to take advantage of near-term pricing dislocations in the market. It may only be 5% of your money. It may be 7% of your money. It may be 10% of your money. But again, if we're trying to craft a portfolio that can do well in up markets, down markets, and sideways markets, you need some money inside of your portfolio that can take advantage of near-term pricing dislocations. Again, it's not predicting. It's not trying to look into a crystal ball. I mean, I know Wall Street wants you to think that you can't play defense, that you can't be opportunistic, yet they do it with their money all the time. I mean, it's just so frustrating. When I hear that, you just have to set it and forget it. And if you want to set it and forget it, don't work with an advisor. Again, save that fee. I mean, just don't do it. If you believe in buy and hold, you don't need somebody to hold your hand to make you feel good about losing money. Call me. We'll set up an asset allocation. We'll charge you a very nominal financial planning fee, and then talk to us once a year if that's truly what you want to do. So don't pay the advisory fee. So, and then the last bucket of money again is cash flow and tax planning. When it comes to cash flow and tax planning, we want to invest in strategies that can pay low double digit distributions independent of the stock and bond market, and those investments exist. Now, they do take some education. There is some qualification requirements that you have to meet as far as net worth or investable income, but if you do meet those requirements, which many people do, I mean, it's not, in today's day and age, it's not super unattainable, but those distributions are going to come as long as the business is doing well. And it doesn't matter what happens in the stock and bond market. So we think that's a strategy when it comes to portfolio construction, that fractions of a percent, lowering fees. If you want to set it and forget it, don't pay an advisory fee. Do it on your own. We'll help you do that. But that's how we think we craft a portfolio that can do well, whether the markets are up, whether the markets are down, or whether the markets are sideways. So with that being said, give Paige a call, 630-492-1912, 630-492-1912, and let's have a conversation. Or go to the website, kuhncp.com, kuhncp.com. When we come back, we're going to talk about taxes and strategies and what exactly are we investing in that can give you, significant tax benefits. So more after the break.
Hoping is good. Knowing is better. You are unique, and your investments and plans should reflect that. Investors today want defined outcomes, not investments that simply track the stock market up and down. Did you know most of all mutual funds and managed accounts by prospectus must stay fully invested no matter how good or bad the stock market is? There is a better way. We want our clients to use portfolio gains to compound their investments, not make up for portfolio losses. Schedule a complimentary call with Robert. With Kuhn Capital Partners, partnership isn't just a promise, it's in our name.
You're listening to Destination Retirement. My name is Robert Kuhn, president and founder of Kuhn Capital Partners, independent registered investment advisory firm. Yes, we are fiduciary. We are financial planning based. We're bringing you cutting edge technology that most advisors simply aren't going to bring to you, especially in the future income planning space. I love the commitment that we made, and our income labs were very, very pleased with the response there. And I think you'll find it very, very interesting. Our job as investment advisors and financial advisors and just people who provide advice to individuals is to make sure that we're crafting a portfolio that can do well whether the markets are up, down, and sideways. Most advisors certainly will do well when the markets are up. They will not do well when the markets are down, and then who knows what's going to happen when the markets are sideways. So if you're working with an advisor who simply crafts a portfolio that really just simply follows the market up and down, it's probably not good enough. It's certainly not good enough in our eyes. It's certainly not good enough long term. And as I mentioned in the last segment, fractions of a percent can have a dramatic difference over time. 1995 to June of this year. Less than 1% outperformance from a manager and model that we use versus the S&P 500. Created, if you invested $1 million in 1995, $4.5, almost $5 million of outperformance. And guess what? The return on average was less than 1% more a year. So it can make a big difference, and it is a big deal, and especially in this market, in a market where risk happens and risk happens fast. So give Paige a call if you want to have a conversation, 630-492-1912. We can share with you our strategies that we feel once enacted, we have a portfolio for clients, for investors that has strategies that can do well, whether the market's up, down, or sideways. So that's the really, what we believe wholeheartedly. And that's why I think we attain and, have the clients that we do, because they want more than just to ride the market up and down and pay an advisor a fee for that right. So don't work with somebody who is you're paying a 1% to 2% fee just to make you feel good when the markets are down. That's just not good enough. So if you want to have a conversation, give Paige a call, 630-492-1912, 630-492-1912. As always, we're headquartered in Chicago, but if you're listening to the show, then we have representation, and our team works in your area. So don't let the area code fool you. We can certainly work together, and we do get that question a lot, which is why that I make sure that I say that every segment. So we're continuing to grow the show. We're continuing to look at new markets, and we're very, very pleased with that. So give Paige a call, 630-492-1912. Okay, a couple things. It's the last segment here today. Risk. We're going to certainly talk about taxes. We're going to certainly talk about the investments in the private space that, we're seeing a lot more investors look at, and why. But I want to take, a step back. And I saw a question this week, and it was from a investor, and they were looking at, the question was, do you know of any bricks and mortar banks that provide good CD rates? And, the greatest compliment I think I've ever received from a client was, you educate in such a way that I am not and have not been a financial expert when it comes to investing, but you allow me to understand investments that are generally complex, but you break them down in such a way that I can understand them, and then I can make a decision. And to me, that was honestly one of the best compliments I've ever received, because my job as an advisor is not to tell you what you're doing wrong. Most advisors are probably going to tell you why they're the best, and they're the only ones that can do this. They're the ones, that have the best this, the best that, and you're not smart enough to do what they do, and blah, blah, blah. That's not us. And we're never here to tell you that. My job is to educate you on what you have and what you could have, and what are you trying to accomplish? Do you want a strategy that simply follows the market up and down? Okay, fine. That's probably not us. Do you want a strategy or strategies that can, do well in theory in all markets? Well, then, okay, we need to start talking about why we may be a good, fit for you. But my job is to educate you on complex institutional strategies that you can understand. And so then you can make a good educated decision on what's best for you and your family. And that is something that, we're here to do, and we strive to do each and every day. So one of the question I had is, so somebody wanted, a bricks and mortar bank for CD. And yeah, CDs are great. CDs, are FDIC insured. You don't have to worry about it. But you have to think, are we just exchanging one risk of market risk and volatility risk for another risk of, look at where inflation is. Look at where, inflation is going. Look at what you're getting after taxes. I mean, are you just really saying, okay, I don't want to look at my statement and see volatility, and you're just really exchanging that risk for an investment that's not going to keep up with inflation, that's not going to, allow your purchasing power to grow? I mean, I get the need for a level of certainty. I totally understand that. But, my question to that person was, look at what money market rates are paying today. I mean, you can go and get a short-term money market in many instances paying north of 5%. And guess what? That's liquid. There is no time commitment. And, we want to make sure that for those CD investors out there that want that level of certainty, there are certainly some things that are not FDIC insured. Of course not. I mean, there's only, FDIC insured is only when it comes to the CD space. So that, is something you need to know. But there is a level of certainty. Like I like to say, okay, well, we do some JP Morgan investments that are backed by JP Morgan. Is JP Morgan guaranteed? No. Is that investment FDIC insured? No, it's backed by JP Morgan. So if you think JP Morgan is going to be around in, 12, 15, 24, 36 months, and we can get 3, 4, 5% more than what a CD rate is paying, well, maybe that's something that you should look at or at least consider. Maybe instead of doing 100% of the CD, maybe you look at maybe splitting it between a CD and, an investment like that. So those investments are out there. I know a lot of people are looking for a level of certainty, but don't exchange one risk for another. Again, it comes down to institutional level diversification, and we're bringing strategies that are going to be new to you that most advisors simply don't use, offered by the largest, most well-capitalized, financially secure banks in the world. So 630-492-1912, 630-492-1912. Give Paige a call, set some time up for us to have a conversation if you want to learn more about what we're doing. So, okay, we have a couple minutes left. I want to go over taxes. I mentioned earlier that I think the most overlooked area of financial planning is tax planning when it comes to individual investors. Generally, I look at an individual investor as somebody who has $10 million or less of investable assets. And so that may mean you have 100,000, may mean you have 500, may mean you have $1 million, whatever. 100,000, 0 to kind of 10 million. And what I see, if you're working with a big bank, if you're working with a big brokerage firm, you are at a significant disadvantage when it comes to tax planning. Truly the only most proactive strategy that you can do if you're working with a big bank or a big brokerage firm is to match gains and losses and tax loss harvesting. That is not tax planning in any way, shape, or form. And that is it. And ask your advisor, do you have an investment that can drastically reduce my taxable income and to the tune of $80,000 to $85,000 per $100,000 invested, and still pay, high single to low double digit distributions, not based upon the stock and bond market? Ask them that. And the answer is going to be no, especially if you're working with a large bank or a large brokerage firm. So caveat, we're not CPAs. We're not providing tax planning. Anything that we talk about, we want to incorporate your tax professional and just share with them what it is so you can get the legal tax opinion. But it is very cut and dry. In the energy space, you're getting significant, tax benefits. So if you sold a building, we have a lot of investors that are selling buildings, whether it's a residential building or house, an investment property, or a retail commercial building, and you have a lot of embedded capital gains. Depreciation works great, but when you sell it, that basis is zero in a lot of instances, and so you're going to have a pretty hefty tax bill. Or if you are a high wage earner, we want to have a conversation about tax planning. We have 2.5 months left, and we want to at least know, or you to know, that there are strategies out there that are going to take some education, but are relatively straightforward when it comes to ways to significantly reduce your taxable income. Again, 2.5 months this year left, and you're going to be really happy you investigated it if, come tax time next year. So hope everybody has a great week. Hopefully you learned a lot on the show. My ask of you is, if you did, please send the podcast link on to somebody that it may benefit and educate. We want to help as many people as we can. So let's close the show by letting you know how to reach out to us. Set some time up on our calendar with a time that works for you. 2 ways to do it. Call Paige. Paige is our great assistant, 630-492-1912, 630-492-1912. Or you can do the website, kuhncp.com, kuhncp.com. Have a great week, and we'll be back with more education next week.
Thank you for listening to Destination Retirement. Don't pay too much for taxes or retire without a sound retirement plan. For more information, please contact Robert Kuhn from Kuhn Capital Partners. Call 630-492-1912 or visit them online at cooncp.com.
This recording is for informational purposes only and should not be considered investment advice. Kuhn Capital Partners does not provide legal, accounting, or tax advice. Any statement regarding such matters is explanatory and may not be relied upon as definitive advice. Opinions expressed are current as of the date of this recording, and such opinions are subject to change. The views and opinions of guests on this program are not necessarily those of Kuhn Capital Partners. Any reference to guarantees, principal or income, protection, buffers, or defined outcome investments are generally structured notes or fixed insurance products backed by the claims-paying ability of the offering company and are not insured by any government agency. Kuhn Capital Partners is not affiliated with any guests unless otherwise stated and does not guarantee the accuracy or the completeness of any data presented. Kuhn Capital Partners and its affiliates are not responsible for any trading decisions, damages, or other losses resulting from or related to the information, data analysis, or opinions in this recording. Past performance is not a guarantee of future results. All investments are subject to investment risk, including but not limited to the potential loss of principal. Advisory services are offered through Kuhn Capital Partners, LLC, a registered investment advisor.